Good morning, everybody. Hope you're having a good day today. Today we're going to deal with Chapter 2, and you can see from the first page they have on the PowerPoint. Chapter 2 mostly deals with the professional roles and responsibilities that auditors have as they do their work. And so we'll be talking today to a large degree about standards that auditors must meet when they go about doing their specific uh, audit work. And so we'll just go forward as I normally do. I don't go over the learning objectives. That's just sort of uses up time. You can read those on your own. We'd just like to jump into the detail. So on PowerPoint 4, we see it talks about, it says the essentials of auditors' professional roles and responsibilities. So let's talk a little bit about some of the background of the auditing profession. The first point says public accounting, accountants provide assurance services for use by the general public. Assurance services, what is that? Well, an audit is meant to provide assurance to the users of the financial statements. Assurance of what? Basically, assurance that the financial statements do not contain a material error and that the financial statements are reliable. And so we talked the other day about users of financial statements, investors, shareholders, banks, employees, lots of different users of financial statements. And so when they look at this information, they want to know that it's reliable. So auditors provide the assurance that the information contained in the financial statements are reliable. Now, in order to do audit work, of course, around the world, it's the same thing. This particular PowerPoint talks about the fact you must be a CPA in order to carry on a practice of public accounting. Because as a CPA, you have to meet certain standards. And if you don't meet those standards, your license to practice can be taken away from you. Okay, so there's actually two things going on here. You can get education to become a CPA. That's one requirement. But then the other requirement is in order to practice, you must have a separate license. Okay, so there's two things. You need a degree, basically, pass exams to become a CPA. But then if you want to carry on your own practice, you need a license. And licenses in Canada are granted by the different provinces and territories. In the United States, licenses are granted by the various states. Okay, so because of the way our constitutions are organized, provinces in Canada and the states in the United States, they control the labor practices. Okay, how the rules that have to be followed when people work, and so you need both a license and education in order to be able to practice as in Canada, a chartered professional accountant. In the United States, it's the same three letters, CPA, but it stands in the United States for certified public accountant. So the wording's a little bit different, but they do the same function, basically, performing audits. If you want to be carry on an audit practice, both in Canada and in the United States, we have boards that firms must belong to. So in the Canadian setting, it's called the Canadian Public Accountability Board. And what this does is that this board actually audits the audit firms. Because of what was called the Enron scandal, Enron was a big public utility company in the United States, which ended up going bankrupt in part because their financial statements were false and misleading. And they were in a lot of financial difficulty, which was not reflected in an appropriate way in their financial statements. So they went bankrupt. But part of that was that the audit firm that was involved in that particular fiasco ended up going bankrupt itself. It was a firm by the name of Arthur Andersen. And unfortunately for Arthur Andersen, a number of the partners did certain activities that they shouldn't have done. And of course, some of them were convicted of crimes. Some of them had to go to jail. They lost their license to be CPAs. But the upshot or the result of that particular financial fiasco was that in both the United States and in Canada, the government wanted to have more control and influence over audit practice. So in the United States, the Security and Exchange Commission basically took over the responsibility uh, for the management of the audit firms in the United States. In Canada, our government did not get quite as involved because we as a profession took more control over what was going to happen as far as companies that wanted to do audits. And we created this Canadian Public Accountability Board. And so in Canada, if you want to do audits of public companies, you must belong to this board. And as we see at the bottom of the PowerPoint, it says the board will inspect the audit work performed by the firms. And of course, if the audit work is faulty in some ways, there's recommendations made in terms of how it needs to be improved. And of course, the audit firms, if they want to keep conducting an audit practice, they have to meet those standards as set by the Public Accountability Board. So the important point for you to recognize is in both United States and to a lesser degree in Canada, our governments have taken steps to more tightly control the audit profession. Because unfortunately, at the time, it was considered that the audit profession would not control itself. Right? So the government had to get involved, and they did so. Now, in addition to belonging to the Public Accountability Board, if you want to do audits, CPAs have to meet a large number of ethics. Okay, so we have a ethics code in Canada. It's the CPA Rules of Professional Conduct, is what it's referred to as, and there's a number of key important ethics requirements that must be met. And so you'll see a list here in this PowerPoint, number 5. It lists various ethical requirements. So let's just look at the words, and I'll give you some explanation as to what they mean. Integrity. So CPAs must have integrity. Integrity means essentially that you must be honest, right? Honest people don't accept bribes, right? Honest people decide that what is right in a particular set of circumstances, right? So a high degree of integrity or honesty is what we're talking about there. So that goes to the real nature of a person, right? And how you're going to conduct yourself. Objectivity means that you should not be biased when you do your work, right? You should not be under any undue influence by other people or organizations. You should be in a position where you can make your own decisions based on your own knowledge and abilities. So CPAs must be objective when they do their work. They cannot be, for example, under the control of management, right? Professional competency, of course. If you're going to conduct an audit or do other services that the public is going to rely on, you have to know what you're doing, right? And so part of the reason that all of you are studying auditing is that as future members of management, you're going to be interacting with auditors. And so this course helps you understand what their responsibilities are so you can interact with them in an appropriate way. You may even, in some circumstances, assist them in the conduct of their audit, because that's also possible under the audit standards. So you may get to know the auditors fairly well. Or even if you don't work directly with the auditors of public companies, you may be involved in auditing from a perspective of ensuring that your own business or the business where you're working has adequate accounting controls, right? So we talk about accounting controls later in the course, but you may be dealing with that aspect of your business's internal control system, trying to make it better. Well, in order to do all these technical things, of course, you must have adequate technical skills. So this is what professional competency is talking about. And then in addition to these professional skills, when you first become a CPA, right, most of the time people are younger, and there's an issue, how do you maintain your professional competency over your career, right? Because we don't want to just sort of get educated when we're maybe in our 20s and then forget about education for the rest of our lives. So basically in the 1980s, the accounting profession in North America decided that ongoing professional development would be required. So currently, the Canadian experience, for example, is that a CPA in Canada over 3 years, okay, must obtain at least 120 hours of formal education, okay, to maintain their skills. So that can be usually attending courses of various type. You select the courses, right? The profession doesn't tell you which courses you have to take, but you take the ones that you're interested in. You take the ones in the area of practice. So if you do a lot of tax work, you'll probably take tax courses. If you do a lot of audit work, you'll probably take a lot of audit courses. Right? If you're involved with IT, you'll probably take a lot of IT related courses. So the idea is your professional competency has to be maintained throughout your career. So we have ongoing professional development that's required, okay, as part of the responsibilities of CPAs. The next item, due care. So when auditors do their work, you want it done properly, right? You don't want it done haphazardly or in a negligent way. So auditors must use due care. Due care is actually a legal standard in the law. So what that means is that when auditors do their work, the legal standard to which they are held is that of what we call a reasonable auditor, right? So when you do your audit work, if there was a problem where you had to go to court and defend yourself, the judge would say, did you do the work that a reasonable auditor would have done, right? Given your education and your knowledge and experience. That's the standard that you have to meet. So you have to be careful, right? Why do you have to be careful? Because other people are relying on your work, right? So you want to be careful when you're doing your work so that you don't make errors. And then the last one, confidentiality, okay? CPAs get access to a lot of what we will call inside information, right? You know what's going on in the company before the stock market does, okay, if you're dealing with a public company. And that would give you the possibility, right, of trading in shares, for example, before the public was aware of information. Well, you can't do that, right? As a CPA, any information that you become aware of during the course of your work, you have to maintain as confidential. You cannot tell anyone else what you find out outside of your audit team. Okay, of course, your audit team itself, the audit teams, when they actually do audits, you may have 5 people, maybe as much as 10 people working on an audit. So when you find out information about your client, you can share it with them because that's, the service you're providing, and all the audit team members need to be aware of information that's relevant to the audit. But outside of the audit team, okay, you can't tell anyone about what's going on in your client's affairs. You have to keep all the information confidential. So if you have a spouse, you can't tell your spouse, can't tell your brothers or sisters or uncles or aunts. You have to keep that information to yourself. And when you keep it to yourself, that also means you cannot act upon it for your own advantage or for the advantage of someone else. Right? So essentially, you have to pretend you don't know the information, even though you do. Okay. Client confidentiality, right, is extremely important because if people thought that you would tell their inner secrets, right, when you did their financial work, for example, that would undermine, right, the ability of people to hire you as a professional, because most people don't want, of course, their financial dealings or family issues that you might find out about, or corporate issues. They don't want that information shared with anyone, right? They want you to keep that in confidence. So that is the requirement of CPAs. Hold the information in confidence, right? And if you hold it in confidence over a period of time, your clients will trust you. Right? Well, that's exactly what the profession wants. They want the public to realize that they can trust, right, CPAs, and because you can trust CPAs, you should hire CPAs to do your audits and other financial duties that may be required. Now, one of the most important ethical standards, and by the way, of course, when you look at this, listen to this PowerPoint, so there's 6 words here, right? Integrity, objectivity, professional competency, due care, confidentiality. I guess that's only 5. But keep in mind, there's many more rules, okay, that pertain to CPAs than these 5, okay? I could give you a list. If we actually went into the handbook, the handbook is a listing of all the professional rules that CPAs must follow. So just as far as ethical rules, there's approximately 300 rules that professional accountants have to follow when it comes to ethics. So it's a very controlled profession, and it's all done for the purpose of maintaining client trust in CPAs. Because if the public does not trust CPAs, we're going to be out of business. If we're not trustworthy people, if we're dishonest people, if we take advantage of information for our own purposes, we're not going to be in business very long. Now, the next ethical standard in the second bullet point in this PowerPoint number 5 talks about independence. Independence is probably the most important ethical standard that CPAs must meet. And when a CPA talks about being independent, they are required to be independent according to the law of our country. You must be independent in fact, and you must be independent in appearance. Okay, in fact and in appearance to other people. Okay, so I often, when I talk about independence in my audit classes, independence in fact is what you do behind closed doors. When nobody's around, or only you and one other person, do you still follow the rules? If you still follow the rules when nobody's watching, right, you're independent. But independence in appearance, that has to do with what people can see, right? So when you're in a group of people and you're making decisions, are you acting in an independent manner, right? So independent in appearance is what people can see. Independence in fact is really what's going on inside of your mind and how you act when people aren't around and can't see what you're doing, right? So the legal requirement and the requirement of the profession is that auditors must be independent both in fact and in appearance. Unfortunately, many auditors have gotten into trouble over past years because they're not independent. How can you have a problem with respect to independence? Well, very often audit firms like their audit partners to be close with their audit clients. The reason that firms want their partners to be close to their clients is because their clients will give them more professional work, right? If you understand what's going on in your client's business, you'll see opportunities, right, to assist them. And when there's opportunities to assist them, you can bill them more money, right? So that's better for the firm. Unfortunately, when you get close to your clients, you might cross the boundary or the line, and you might get too close to your client. Right? So an example is, maybe you're working on the audit of a client, and then on, Friday afternoon, the week's over, we've all been working hard, and so you go out to dinner, have a few drinks with your client. Right? And so what's happening is you're striking up a social relationship with your client, and then maybe your client, right, invites you to various social functions, right? So maybe you go to hockey games or football games with your client. So the relationship with your client becomes much closer. The problem is your relationship with your client can become too close, right? So audit firms want their partners to have close relationships, but not too close. So there's a dividing line there, right? Now, that line doesn't appear anywhere. You can't see it, but you have to use your judgment, right? In terms of, are you getting too close to your client? So let me relay a brief experience I had fairly early on in my career. So earlier in my career, I was an audit partner with Deloitte. And in my role as an audit partner with Deloitte, I looked after a number of audit clients, of course. And one of my clients I got fairly close to. And what happened one weekend was I took my family snow skiing. Okay, so north of Windsor, it's about 400 miles north of Windsor. There's a ski resort, and this is across the border in Michigan, United States. Okay, state of Michigan. So you sort of cross the border at Windsor into Detroit, and you drive north about 400 miles. And once you get there, there's a nice ski resort there. And so I took my family there for a long weekend, 3-day weekend, and then we came back home. But before we left the resort, I came to pay the bill. And the resort told me, oh, it's already been taken care of. And I said, oh, what do you mean? And they said, well, a company by the name of X, and X, we'll just leave it, X Limited, paid for the weekend. So I had an audit client pay for my ski trip for myself and my family. That was completely not planned, unexpected, but I had an immediate concern that whether the fact that they had paid for my ski trip would cause a problem with my independence, right? Because it was a fairly large client I was handling. It was growing rapidly. They were relying on me a lot, right? So maybe I got too close to them, right? It was the issue. So the fact that they paid for that ski weekend, what do I owe them back now, right? Is the problem. And we said a few minutes ago, auditors have to be objective, right? So can I be objective, right, to make my own decisions if I feel I owe my client something, right? Because they paid for my ski weekend. So when I got back to the office, I went and talked to one of my other partners, who was the managing partner at the time, and explained the circumstances. And he asked him, I said, do you think there's an issue with respect to independence? As I said, what I can do is obviously just reimburse the client for the costs of the weekend, because I planned on paying it obviously anyhow. And the managing partner said, no, it was okay. He was comfortable that, it wouldn't cause a problem. And so I just accepted that. And, it never did cause a problem. I was never challenged on it. But again, it was something that occurred. It's an example of, could that have influenced my independence with the client? Possibly, right? So when you're interacting with clients and issues arise, right, that could create, at the bottom of PowerPoint 5, you see something called threats to independence, right? What are the threats to your independence? So if you identify a threat to your independence, such as I did, right? The client paid for my ski trip, that's a threat to my independence. I have to do something about that, and we'll talk about that in a few minutes. But the threats to independence, which are identified in our CPA Code of Ethics, are the ones listed here: threat of self-review, threat of self-interest, threat of advocacy, threat of familiarity, and the threat of intimidation. Okay, I thought there was some additional explanation here, but there wasn't. So let me talk about these threats. Self-review. The threat of self-review is when you're reviewing your own work. Right? Well, you can't review your own work, right? That doesn't provide an adequate test as to whether you did a proper job or not. So the type of situation they're thinking of here is where sometimes clients have their auditors provide staff to work at the client's premises. So sometimes, let's say the controller, right, of the business is going on vacation for 2 weeks, and the client needs assistance for the 2 weeks. So an audit staff member comes in and plays controller for 2 weeks at the client's premises. Well, if the audit staff member, right, actually conducts financial transactions, can the audit firm now audit that client, right? So you have to assess whether the fact that you had an audit staff member working at the client's premises for 2 weeks, does that cause a problem with respect to your independence or not? So that's reviewing your own work. Not just your own, but in the example I gave you, it could be someone else who's working within your firm, right? So can you audit your own work? No, of course not. The next point, self-interest. So with respect to self-interest, right, are you and your client, right, is there basically a conflict of interest, right? And so what might happen is your client perhaps, let's say, loaned you money, right, made a loan to you as the auditor. And now you're in a position, you have some financial difficulty and you can't repay the loan. So the audit client says, well, you can't repay the loan. I'm going to maybe forgive the loan or reduce the payments, but I want something in return, right? So in order to reduce your financial obligation, you agree to do something for the client because it's in your self-interest, right, to do so. There's some type of financial gain there. Well, if you and your client, right, are making arrangements like that, that's a possible threat to your independence because you're not going to be acting objectively, right? Because you're trying to get some financial gain from your client. So that can be a problem, of course. Advocacy means that you're taking a position and really acting as a management member. Okay, so if auditors and CPAs are required to be independent of their client, you cannot function as a member of management. You cannot advocate for the client. Okay, so very often, here's an example of how this might be a problem. Very often, clients want their auditors to go with them to the bank to talk to the bank about lending money to their client or to the audit client. So can you do that? So for example, I've had clients say to me, let's go to the bank. We want to borrow $1 million. And we want you, myself, right, as the audit partner to come to the bank and help make that happen. So when I would be asked to do that, but really what the client's asking me to do is come to the bank and advocate for us, right? Tell the bank why they should make the loan. Well, I can't do that, right? If I did that, I would be advocating for the client. And I was always tell the client, well, I'll go to the bank with you, but my role when I go to the bank is not to advocate for you or tell the bank why they should make the loan. I'm just there to answer any questions that they might have about the financial statements of the company, right? So I'll provide more information to help them make a decision, but I'm not going to try to convince them or advocate that they should make the loan to you, right? You can't do that because that would create an independence problem, right? And my independence in appearance. Well, if it looks like you're helping management, you might not be independent in appearance, right? So it's a fine line again. This is why auditors get in trouble with respect to independence. Familiarity comes back to the example I gave you a few minutes ago with respect to the ski trip. I'm too familiar with the client, right? I have too much of a personal relationship with the client in addition to the professional relationship, right? As CPAs, we have to be independent in fact and in appearance. So as I said a few minutes ago, if your client pays for your ski trip for your family, what would someone else think about that, right? That's really the test. If you ask someone else as to whether you would still be independent or not, they may say no, right? And that's why there's a threat, right, when that happens. Now, our professional rules of conduct say that if a client gives you a gift, it would only be a problem if you were not in a position where that gift was not significant, right? So the client did pay for my ski trip, but I could have easily afforded that myself, right? I wasn't under any type of financial difficulty. I wasn't in a position where I couldn't pay for the trip. The cost of the trip was, well under what I was earning at the time as a partner in Deloitte. So easily I could have paid for it. So because of the dollar amount for the trip versus my income at the time, that's why the managing partner said, I don't think there's a problem. But had the cost of the trip been much larger, right, compared to my income, maybe there would have been a problem, right? But again, these are judgment areas, okay? But the idea of being familiar just means that you have too close of a personal relationship in addition to the relationship you have as a company's auditor. And then the last one, intimidation. Auditors cannot be in a position where their clients intimidate them. So, for example, a client might say, let's say that inventory, for example, in a client's financial statements is too high. Okay, let's say the recorded inventory is $2 million and it should only be $1.5 million. So you want their client to write down the inventory from $2 million to $1.5 million. And the client says to you, if you force us to write down our inventory by $500,000, we're going to fire you as the auditor, right? Or we're not going to pay your bill for this year's audit. So the client's intimidating you, right? So if a client's intimidating you, can you be independent in appearance and fact? Maybe not, right? Because you may be put in a position where now you have to do something in order to get your fees paid, or you have to agree to not writing down the inventory because the size of that engagement is too important to your practice. Your firm can't afford to lose that client, right? And so this is why very often when we do our professional work, client audit firms have to look at their clients and say, if a client represents too much of our total revenue, we can't service that client anymore, right? Because they're too large of a piece of our practice. And so we have to ask that client to go to another CPA firm. Now, of course, firms will do a lot of things to try and reduce these threats, right? So just because you have a threat in one of these 5 areas, that doesn't mean you say goodbye to the client, right? What you have to do is take steps in the audit firm to eliminate the risk or to reduce the risk to an acceptable level, okay? So reduce the risk or eliminate the risk. So eliminating the risk probably would mean you have to give up the client, right? And ask the client to go to another CPA firm. To reduce the risk, there might be steps that you can take other than just losing the client. So for example, if a client says we don't want to write down the $500,000 in inventory, maybe you get another audit partner to come in and talk to the client, right, about why they need to make that adjustment, right? So someone who's not as close to the client perhaps comes in and helps to get the required adjustment done. In a case where an audit staff member has to come in and help the client because the controller's away, right, for 2 weeks. Maybe it's not someone that reports to you in the audit firm. You get a different CPA, right, from a different audit staff to go in and do the work, so that the audit team that's auditing the work is not the same audit team that actually did the work, right? So there are things you can do to reduce the risk to an acceptable level, or worst case, you have to eliminate the risk, which means you may have to ask the client to go to another firm. Firms, of course, are going to take all kinds of steps to prevent that from happening, because firms want to grow, right? They want to keep their clients. You can't grow if you're going to be losing clients in that manner, right? So firms normally will take steps to reduce the risk to an acceptable level. They're going to try not to have clients leave the firm. Okay, so moving on, the current environment of auditing. And so there's some older things that happen here, but they're still affecting the audit profession today. And I've already referred to at least one of these. It says the audit environment has undergone a profound change following several spectacular corporate failures, such as Enron. Enron was the one I mentioned a few minutes ago, where the audit firm Arthur Andersen went bankrupt, unfortunately. And there was another fraud called WorldCom at the time. They all occurred at the time of what we call the dot-com bust in the stock market. So that was around 2001, 2002 timeframe. And then, of course, we've had the economic crisis that occurred back in 2008, 2009, which, of course, had devastating financial effects around the world, and really that we're still recovering today from, even though this occurred 12, 13 years ago. The next point says, as a result of these failures, the integrity of capital markets is being questioned all over the world because of fraud in financial reporting, right? The financial statements were not reliable. The auditors were not doing a very good job. They weren't catching the fraud that management was conducting in the financial statements. And so this resulted, as I mentioned, in legislation. The US basically took the lead here. Of course, they have the largest financial markets in the world, so they had to control the audit profession. And so in the United States, they passed an act called the Sarbanes-Oxley Act. So we usually refer to that, you see the short form here, SOX, right? Call it SOX for short. And Sarbanes-Oxley Act put in a lot of controls over auditors. And one of them I've already referred to, the Canadian Public Accountability Board, right? So that board audits the auditors. And the US has a similar board in place, okay, for public company auditors, where that board also audits the auditors. So unfortunately, unfortunately for the audit firms, right, after 2002, they now have someone looking over their shoulder, right? They have the government overlooking them to make sure that proper work is being done, okay? Because of the public interest, of course, in auditors and ensuring that financial statements are correct. Now, this legislation that came in the United States, Sarbanes-Oxley, in Canada, we had similar legislation enacted, okay? And in public companies, of course, auditors have to follow the requirements of the Sarbanes-Oxley Act. So in the North American environment, this has had a great influence on how audits are conducted. It's all been for the better, okay, in terms of quality of audits. Unfortunately, it comes at a cost, because most things, you can't have more of something without increasing your cost. So over a 10-year period, if you went from 2008 to 2018, the cost of an audit for a public company has increased about 40%, 40%, okay? So that's a big increase, isn't it? And that increase results from a number of things contained in the Sarbanes-Oxley Act. So there's a little, what we call laundry list of things here. So let's see, how did the Sarbanes-Oxley Act change or impact what auditors do? So the first point says increased oversight of auditors, including audit standard setting by the new Public Company Accounting Oversight Board. So the PCAOB, okay? So both in Canada and the US, we have a Public Company Accounting Oversight Board. That's the board that audits the auditors. Well, that's a cost, isn't it? Somebody's got to audit the auditors. The audit firms have to pay that cost. Well, if the audit firms have to pay that cost, who's going to pay for that cost as far as the audit firms go? They have to pass that cost along to someone, right? So what the audit firms do is they increase their fees that they charge to their clients, right? Because the audit firm's position is, we're not going to pay the cost. We're going to pass that cost along to our clients. So the cost of an audit went up because of the need to audit the audit firms. The next point, increased penalties for corporate wrongdoers. So the act now requires the CEO and the CFO to certify the financial statements each year. By certify, that means they have to write their name, okay, on a report where they certify that the financial information in the financial statements is correct. So the fact that they now have to sign some documents saying that the financial statements are correct, they can be sued, right? If they sign something and it's not true. So there's going to be increased penalties, right, if they do that, both possibly jail time as well as financial penalties. The next point, more timely and extensive financial disclosures by companies in their actual quarterly reports, okay? The next point, more timely and extensive disclosure of the way the firm is governed. So corporate governance over the last 10 years has taken on a new life. We have to have more corporate governance. We have to have more transparency, right, of corporate governance, so the investing community can see what's going on in the business as far as governing of the business. And this, of course, is done through the board of directors and the strengthening of audit committees that sit on the board of directors, okay? So you can see here all these different points. It's talking about more, right? More oversight, more procedures, more governance. Well, these things are nice, but they come at a cost. And so that's why, of course, audit fees have gone up significantly over the last 10 years. The last point mentions new options of recourse for aggrieved shareholders, including increased legal liability for auditors. Well, of course, when we increase the standards, right, the auditors have to meet, that creates more legal liability for audit firms. If the auditors weren't meeting the lower standards, what happens when the standards get raised? It creates more liability, right, for the auditors. So in order to reduce that liability to a reasonable level, what do the auditors have to do? Auditors have to do more work, including changing the type of work that they do. Okay, well, more work and changing the type of work we do, that results in what? More cost, because we have to spend more time doing the actual audits. So that extra time has to get passed along to somebody, right? The audit firms themselves are not going to absorb that. So that means the cost of audits goes up. So all these things I'm talking about has had the effect of increasing the cost of having audits. The next point, it mentions management certification of the financial statements. I've already just mentioned that, right? The CEO and the CFO have to sign off on the financial statements each year. So that creates legal liability for them. That wasn't required, okay, before 2002 when the Sarbanes-Oxley Act came into existence. Management didn't have to certify, but now that they do, that creates more liability for them. The next point, very important as well, an evaluation of internal control and statements made by management. Now, the auditors, up until 2002, they just reported on the financial statements themselves. As a result of the Sarbanes-Oxley Act, the auditors also have to report on management system of internal control over financial reporting. So does management have a proper system of internal control in place in order to ensure that the financial statements are materially correct? Yes or no? Right? Hopefully the answer is yes, but if the answer is no, it means some remedial action or correction is necessary. So now the auditors have to give a second audit report, right? First, they just audited the financial statements and give a report on that. Now they have to also audit the internal control system over financial reporting and give a report on that. So what just happened? Auditors have to do more work, audit fee goes up. The next point, closer regulation of the profession, including regular monitoring of its activities. That's done through the public accountability boards, right, to ensure that auditors are challenging themselves enough to do the type of work they should be doing. The next point, greater responsibilities assigned to client audit committees. I mentioned that a minute ago. An audit committee is a part of the board of directors of a company, and the audit committee has higher levels of responsibility now to interact with the audit firm to ensure that an audit is being performed in a proper manner. Okay, and so there's ongoing meetings throughout the year as the audit is completed between the audit committee members and the actual audit firm itself. Another major change, and this had been in process actually for a number of years, it says increased importance of the role of the internal auditor. Now, an internal auditor is an auditor who is hired by the company itself, okay? And so most large public companies, they have what's called an internal audit function. So they have people who are trained in auditing that are carrying out audits on a day-to-day basis, week-to-week basis, to ensure that the financial information being generated by the company is accurate and complete. The external auditors now, okay, as a result of the Sarbanes-Oxley Act, put more reliance on the internal auditors where that role exists. Now, it doesn't exist in every company, but most public companies do have an internal audit role. And so if the external auditors, Deloitte, KPMG, etc., if they're going to rely on the work of the internal auditor, they need to have more interaction, right, with the internal auditor and more direction over the work done. So this has enhanced the role of the internal audit function within client organizations. But keep in mind, right, anytime you're talking about the external auditor doing more work, right, having more interaction, whether that's with the audit committee, whether that's with the internal audit function, it's all going to increase cost. right? And again, that's why audit costs have gone up 40% over the last 10 years. And you'll hear business leaders on various business shows from time to time complaining about Sarbanes-Oxley and the fact that it's driven up their costs so much. But the cost was driven up. Again, you have to reflect on the history of it. It was driven up because too many client member management teams were not honest in their financial reporting, right? And so a higher level of control was required to ensure the integrity of financial reporting. Okay, this PowerPoint just talks a little bit about internal controls, audit committees, corporate governance. I've already mentioned that though, so I'm just going to bypass that particular one. And we'll go into talking a little more about the regulation of audit firms. So as I was speaking a few minutes ago, before 2002, so that's before the Sarbanes-Oxley Act in the United States, it says the profession was largely self-regulating around the world. Self-regulating means we managed ourselves, right? We regulated ourselves, we set the standards ourselves and expected people to follow them, right? People being the firms. So trust in a self-regulated audit profession says change with the U.S. corporate scandals. So Enron scandal, WorldCom scandal, and there's about 10 or 12 big ones that all occurred back at that time that undermined, right? That undermined the trust that the public had in the auditing profession. So as we said a few minutes ago, the Public Company Accountability Board in the United States and similar one in Canada now has final say over what the audit standards are that the firms have to follow in the US. Okay, so in the US, the governing body, the oversight board, has that control. In Canada, that board does not have the control. The board in Canada still does audit the audit firms, but in Canada, the profession ourselves, our governing body, continues to set the regulations. But the reason our government in Canada did not get as involved as they did in the United States is because in Canada, we said, we'll change our structure and an organization so that we follow all the same rules set out by Sarbanes-Oxley, but without the government involvement. So in Canada, because the audit profession said, we're going to get control over the situation, and we're going to take the steps that are necessary, right, to have a better audit function, the government said, okay, we'll let you do it yourselves. We're still going to audit you through the Public Accountability Board, but you can still set your own regulations. So the two organizations in Canada and the US are slightly different in that regard, but you still have the involvement of the government to some degree through these public company accountability oversight boards, right? Because the government wants to ensure proper financial reporting so that investors are not defrauded of their money. Okay. This particular PowerPoint is talking about the Canadian response itself. So again, because we're dealing with an international course, we're not going to talk about some of the specifics about what's going on in Canada. Again, this particular PowerPoint is talking more about the Canadian scene, so we'll just bypass that. Okay, so we're going to get to the next major topic in this chapter. So that gives you background about how the government's been involved and how some of the ethical standards, right, that have to be met, objectivity, integrity, right. We've had independence being a big one, the threats to independence that may occur. So a lot of those ethical standards are the ones when you do your project A, okay, for this course, a lot of those ethical issues are embedded in that case, okay, and are there for you to recognize. Now, some of the other things in that case are what we're going to talk about next, the practice standards. So in addition to the ethical standards, there are a number of other standards that CPAs have to meet when they do their professional work. Okay, so I'm just looking at the clock here right now. I've been talking for about close to 50 minutes or so now. So I'm just going to stop now, take a little break, let you guys refresh yourself, and I'll be back in about 10 minutes or so, okay, between 5 and 10 minutes, and then we'll continue on with the class. Okay, so I'll see you shortly. Again, we have the ethical standards, which are already always in the background that we've talked about already today. And then we're going to get into, as I said, the more detailed practice standards. So what standards have to be met by CPAs when they're actually carrying on their audit practice? So the first one, it says CASs. These are Canadian audit standards, but they are the same as the international audit standards. Right? So I've mentioned before, Canadian standards, international standards are the same. So don't have to have any concern there. So these audit standards, it says, are referred to as GAAP. So the GAAP refers to generally accepted auditing standards. In an international context, generally accepted auditing standards are the International Audit Standards, IAS, okay? But the IAS standards are the same as the CAS standards. So again, we can use them interchangeably for purposes of our course. There are other assurance standards, it mentions, that we have in Canada. So these assurance standards that are being referred to, they're very similar to the audit standards, but they apply to work other than audits. Okay, so audit firms do audits, but they also do other types of work. And we're going to talk about these later in the course. But for example, review engagements. Okay, a review engagement is an assurance engagement to which the assurance standards apply. Okay, and a review engagement, of course, is not an audit, so the audit standards would not apply to a review engagement, but the assurance standards do. The assurance standards are very similar to the audit standards. Because of the concern, right, of the government over how audit firms are actually functioning and wanting to more tightly control themselves, in Canada, because we've maintained control over the audit profession and less government involvement versus what they have in the US, we actually have something called CSQC1, which is Canadian Standards of Quality Control. So what types of quality control standards should firms have, right? Should audit firms have if they want to do high quality audits? So these same quality control standards have been put in effect in audit firms throughout the world. Okay, so the Canadian standard has essentially become the international standard as it relates to quality control. In addition, as part of controlling the quality of work done by audit firms, point 4 mentions quality control standards are reflected in firm peer reviews. Okay, so a peer review is when, for example, KPMG may go in and do an audit of Deloitte's audit practice, or Deloitte may go in and do an audit of Pricewaterhouse's audit practice. Those are peers, right, doing audits of each other. In addition, it mentions provincial institutes. So as I mentioned earlier today, provinces in Canada actually license auditors to do their work. And so our provincial bodies also do what's called a practice inspection. Okay, so it's similar to firms auditing themselves. It's just the governing body in Ontario is called CPA Ontario. Okay, so they will come in and actually do a practice inspection to make sure that you're following the standards in an appropriate way. Now, generally accepted auditing standards, it says, identifies the objectives and key principles of a financial statement audit. What is it that an audit should achieve? Okay, they talk about the specific audit objectives, CDS 200, etc. Again, you're not responsible, okay, in this course for knowledge of what each of these specific standards, okay? We're just here to build up your overall knowledge in auditing in terms of what it's about. I will be talking to some degree about the content of these standards, but you're not responsible, to be able to quote what's in CAS 200, okay? Not responsible for that level of detail. So when we talk about an audit being done of a financial statement, what is the overall objective of an auditor when they audit a financial statement? The overall objective is to enable the auditor to express an opinion. Okay, so the auditor has to give an opinion on the financial statements. an opinion on what? On whether the financial statements are prepared, okay? Prepared by who? Prepared by management. Whether the financial statements are prepared in all material respects. So in auditing, we have a concept of materiality. Auditors are not saying that a financial statement is 100% correct. What auditors are saying is that the financial statements being audited are correct and close enough to have users rely on the financial statements. Okay, so they're not saying the financial statements are perfect. They're not saying they're 100%, but they are close enough to being 100% to be able to be relied upon. Okay, we use the word material. The financial statements in all material respects are in accordance with, and then it says an applicable financial reporting framework, which in our context is international financial reporting standards. Okay, so the main goal of an audit is for the auditor to express an opinion on whether the financial statements in all material respects are in accordance with international financial reporting standards. Now, in order to fulfill this objective, there's what's called a three-party accountability. And okay, I thought they had a chart, but the three-party accountability is this. There's management. Right? Management's responsible to prepare the financial statements. There are the users of the financial statement. That's the second party. Right? Management prepares the financial statements because they want the users to rely on the financial statements. But the users don't trust management, right? Because the users think that management may manipulate the data for their own purposes. So the users want an intermediary to audit management's financial statements. That's where the third party, the audit firm, comes in. Right? So the audit firm audits the financial statements prepared by management in order that the users will rely on those financial statements because the auditors say the financial statements are materially correct. Okay, so when we talk about the three-party accountability, it's the users relying on the financial statement, management who's preparing the financial statement, and then the audit firm rendering an opinion as to whether the financial statement is materially correct. If it is, the users will rely upon it. Now, generally accepted auditing standards actually consist of three different standards. Okay, and so we're going to review these. So these three specific standards are the standards that the auditors must follow as they do their detailed audit work. And you'll see that these standards are reflective of the ethical standards that we've already talked about earlier today. So the first one, the general standard, it says the auditor should comply with relevant professional ethical requirements relating to audit engagements. So a number of those we looked at. Auditors should have professional competence. Right? We've already talked about that. Auditors should act in an objective way, meaning they should be making their own decisions, not be under undue influence, which means what? They should be independent of management, right? Independent in fact and independent in appearance. When they do their work, they should not be negligent, right? They should use due professional care. So we're just going to look at a few PowerPoints talking about these three elements, right? Competence, objectivity, and independence, and due professional care. So the first one, competence, auditors have to have adequate technical training. How do you get adequate technical training? Well, you take courses in auditing, just like the one that you're taking now, and you have on-the-job experience, meaning that you actually go out and perform an audit. Because auditors are competent, what does that allow them to do? The first point, they can recognize the underlying assertions made by management. What are the assertions made by management in a financial statement? So what we'll talk about later in the course, let's talk about inventory, for example. If inventory appears in a financial statement prepared by management, What is management asserting about that inventory? Management's asserting that the inventory exists, right? Because if the inventory didn't exist, it shouldn't be recorded in the financial statements. Management is asserting that the inventory has been properly costed, right? Costed meaning that the cost per unit has been appropriately determined. Management is asserting that the sales value of the inventory is greater than the cost. So there are not unrecorded losses, right, in the financial statements. So management makes assertions. The auditors have to have competence to audit management's assertions. How do they do that? The second point, auditors obtain evidence, audit evidence to support management's assertion or to determine that the assertion is not true. So auditors gather evidence. How do they know what evidence to gather? Because of their technical training. How do auditors gather evidence? By doing audit procedures to gather the audit evidence. How do the auditors know what procedures to use? Because of their adequate technical training. Once they gather the evidence using the procedures they've identified, they have to state a conclusion, right, on the evidence. So they have to evaluate the evidence to determine whether it is accordance with generally accepted accounting principles, which in our environment, we're talking about IFRS, right? Are the financial statements in accordance with IFRS or not? So obviously, competence is very important. Okay, my computer just froze up for some reason, everybody. So I'm going to have to go out of the class and come back in. So I'll be right back in a couple of minutes. have an objective state of mind when they do their work. And we said that means they have to be honest, not biased. They have to be impartial. And we mentioned the importance, right? Independence, in fact, has to do with what's going on with your own mind, right? Your mental attitude, your state of mind. And then independent in appearance is, how what others see, right? And so I often talk about this. Independence, in fact, means what's going on, right, when no one's around. That reflects your attitude, your state of mind. And then what's happening with respect to, are you being independent in appearance or not? Right? And that has to do with, of course, how you're interacting with other people, other colleagues, other clients, other colleagues, professionals. And that's what people can see, right, in terms of your behavior. The third part of the general standard was due professional care. We have to, of course, follow the rules of professional ethics. We have to follow the rules that we're talking about right now, generally accepted auditing standards. I mentioned earlier, due care is important because it's a legal concept, right? Due care is practiced and achieved if you do the work of a prudent auditor. Due care is a matter of what competent auditors would do and how they do it, right? So again, you want to be careful when you're doing your audit work. You don't want to be negligent, because the test will be, did you follow due care in your work? Which means, did you do the work of what a competent auditor would do? And of course, lawyers, right, will try to attack the work that you're doing and say that your work was not done in a competent manner. Okay, so the first practice standard is the general standard, right? And it has the three components that we've just talked about. The second set of standards is called the examination standards. So we see here in PowerPoint 24, now there's a separate set of standards called the examination standards. They set the quality standard for how an audit is conducted. And we're going to see these words again and again and again throughout the course. But the second bullet point says these standards relate to the sufficiency and the appropriateness of audit evidence, okay, to support the auditor's opinion. We already said what the auditor wants to do in conducting an audit is to render their opinion. That's it, okay? In terms of what an auditor does in an audit, they render an opinion. Now they have to do audit procedures, right? In order to render an opinion, they have to gather audit evidence. They have to evaluate the audit evidence. But when they gather that audit evidence, what type of audit evidence should they gather? The examination standard says they should gather sufficient audit evidence. That means they should obtain sufficient or enough. It's a quantitative standard. Okay? We have to have sufficient audit evidence. And so as you interact with auditors, they're trying to gather sufficient audit evidence. And then not only do they need enough audit evidence in terms of quantity, they need the right type. Is the evidence appropriate, right? So that goes to the type of audit evidence, the quality of the audit evidence. So what the second point is really saying is auditors must make sure they have enough audit evidence in terms of quantity. They must ensure that they have the right type of audit evidence, the appropriateness or quality of what they have. Okay, so there's both a quantitative and qualitative aspect to audit evidence. As part of the examination standard, it says the auditor must conduct their audit in accordance with, of course, international audit standards, right? In our context, again, the same as the Canadian standards. In determining their audit procedures that they're going to perform in accordance with the international audit standards, the auditors have to determine the scope of the audit. Excuse me. What is it that we have to look at in order to render our audit opinion? The scope of our work, right? If you have a medical condition and you have to have heart surgery, the doctor has to determine, right, before they do the surgery, how am I going to go about to do this surgery? What is it exactly that I have to do? An audit is the same way. right? I'm looking at a client's financial statement and I have to say, what is it that I have to do in terms of the detailed procedures in order to have a successful audit? Just like the heart surgery, right? What does a doctor have to do to have a successful heart surgery? Auditing is the same way. What is it that we have to do to end up with a sufficient audit? Now, when auditors do their work, we already said auditors do not provide a 100% guarantee, right? But auditors have to provide reasonable assurance that the financial statements taken as a whole are free from material misstatement, right? Because in the audit report, it says that the financial statements in all material respects present fairly. So when we're talking about materiality, what does that mean? Well, it means that auditors cannot audit financial information 100%. Why? It would take too long, okay? Take too long in time. So if our client has a December 31st, 2020 year end, when do they want their audited financial statements? Usually by end of January or mid-February, right? Just 4 to 6 weeks after the year end, the board of directors is going to want their audited financial statement and your audit report. So we can't take more than 6 weeks, maybe 8 weeks to get the audit done, right? After the end of the year. We can't take a year, we can't take 2 years to audit 100% of the information. So this requires auditors to test data, right? We can't rely and look at virtually every transaction. It would take too long. And if we did look at every transaction, what would happen? That would drive up the cost of the audit. So clients wouldn't pay us, right? The audits would be too expensive. So auditors have to take some risk. So they can't test 100% of the information. So what do they have to do? They have to obtain a confidence level, usually of 95%. So what auditors do is they design their audit procedures so that at the end of the audit, the auditors can say, we are 95% confident that these financial statements do not contain a material error. Could there be a material error? Yes. The auditors are taking a 5% chance normally that there's a material error, right? So being in the audit business is not risk-free. There is risk when they sign the audit report. It could be wrong. The last bullet point in this PowerPoint, it says the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated is called audit risk. So if auditors do their work to obtain 95% assurance or confidence, what is the audit risk? The audit risk is 5%. Right? The auditors are taking a risk that the financial statements are materially misstated by 5%. The reason they're doing that is so that they can keep the cost of the audits lower and they can get their audits done faster. Okay, so it's a cost benefit, right? The benefit is they're still going to be in business. The cost is they could get sued. Now, most of the time they don't, right? You hear about financial statement audits gone wrong, frauds. That's the very small minority of cases. Unfortunately, when those cases occur, they're for large dollar amounts. But most audits are done properly and there aren't any problems. Okay, so this is an important issue to realize that auditors provide reasonable assurance, not 100% assurance, not a guarantee, and that auditors do take some level of audit risk, normally 5% in most public company audits. When auditors do their work, the examination standards require that they plan and perform their work to reduce the audit risk to 5% to an acceptably low level, 5% or lower. That is consistent with the objective of the audit. Remember, the auditor wants to express an opinion that the financial statements in all material respects, right, are correct. So when they say in all material respects, what they really mean is 95% confidence. Okay, 95% confidence. The risk is 5% that the financial statements could be in error. When auditors plan and supervise an audit, they not only plan the procedures they're going to do, but they have to supervise the people. But when they plan an audit, they have to first prepare what's called an audit program. An audit program is simply a list of all the procedures they're going to do, the timing of when they're going to do it, okay, at what point in time, and then who's going to actually do the work. They have an audit team. They have to assign the procedures to members of their audit team. Okay, and after the midterm exam, you're actually going to work on an audit program. Right? We'll get into that level of detail where you'll be able to do it yourself and, of course, work with auditors in designing audit programs. So an audit program just reflects the detailed work, the detailed procedures that the auditor is going to do, who's going to do it, and the timing. Okay, at what point, what day, what month is the work going to be done? In addition to planning the program, they have to supervise the work. Who is going to be responsible for supervising the people and ensuring that the audit staff get the work done? Right, somebody has to do that. Normally called an audit manager. Okay, firms have audit managers that oversee their audit staff. The next point says auditors must obtain knowledge of the auditee's business, right? So if you're going to audit a financial statement for a business, you have to know how the numbers are derived that form the content of the financial statements, right? So if you're going to audit Tesla, right, how does Tesla generate sales? Well, one way they do it is by selling cars. So how are you going to verify, right, as the auditor, that the sales revenue for cars is properly recorded? Auditing car sales, right, is different than auditing, let's say, an electrical utility that's selling electrical power, right? That type of revenue is different than the revenue generated from selling cars. So that revenue would have to be audited in a different way. So you have to have knowledge of your client's business in order to properly design the detailed audit procedures. Right? How are you going to audit sales is affected by the way that your client generates sales. And then thirdly, if there are differences of opinion amongst the audit firm's staff or management, how are those differences of opinion going to be resolved? And this is something that's fairly new in the audit world because there was a recent case that was settled, unfortunately, negatively for the audit firm involved. But it was a situation where a number of partners in one audit firm got together, had a meeting, and after the meeting was done, and in fact, there was no agreement as to how to solve a client problem. And each of the partners went their own way and did different things. And the financial statements ended up getting issued and they were wrong. There was a material error and the audit firm was sued and the audit firm lost the lawsuit. Well, part of the issue that arose there, of course, was the work of the individual partners. And the fact that they had had a meeting and not documented what was said at the meeting, they didn't document what was agreed to at the meeting, the whole thing was mismanaged. Right? So as part of planning and supervising an audit, you have to say, how are we going to manage differences of opinion amongst our audit team members when they arise? Because people will have different opinions, right? When work is planned, a written audit program, it says, is desirable. So when I first started my career, excuse me, and I was put in charge of audit work, back in those days, many clients, okay, auditing firms did not actually create a written audit program. So that when the audit team went out in the field, the client's premises to do their work, they didn't really know what they should be doing. So what I started to do was exactly what's written here. I would actually write down all the detailed work that had to be done, who was going to do it, and when it was going to be done. So what happened was I was spending a lot of time doing the planning, right? So on a large audit, the planning normally might take 20 hours. I was spending 50, 60 hours doing the planning. So the partners at the time, they were getting upset with me. But what they discovered was at the end of the job, we had reduced the number of hours spent on the audit by several hundred hours, right? So instead of spending 2,000 hours on an audit, we spent 1,500 hours, right? So I eliminated 500 hours of time by spending an extra 30 hours on planning. Because what happened when the staff got into the client's premises, they knew exactly what they had to do on what day, right? And who they had to report to. So they knew exactly what was going on, as opposed to getting out to the client's premises and having their morning coffee and donut before they started work and said, oh, what are we going to do today? A lot of wasted time, right? That's being charged to the client. So my audits became very efficient. Once the partners learned that, they realized I knew what I was doing. And of course, all the partners wanted me on their jobs then because I ran very efficient audits. And we've already talked about the fact, of course, you have to know your client's business in order to develop the proper audit procedures. Okay. The timing of audits, we'll talk a little bit about that, and we'll talk about this throughout the course. But let's say that our client has a December 31st year end. I've already mentioned that most of the time management wants their audit report by the end of the following January or mid-February, end of February latest. So how do auditors get the audit report issued that fast? The answer is that they start work before the client's year end. Okay, so typically what would happen is this. Let's say the client's year end is December 31st, 2020. Usually the person in charge of the audit, so the audit manager, will start doing the planning in the summer, right? July, August. The reason for that is audit firms tend to have a lot of time available. That's a slow time for them. So they start doing the planning for their work for the year ends. So you do the planning in July, August timeframe. For large public companies, very often the auditors will go out to the client premises before the year end. Okay, so you might go to your client's premises in September or October based on your audit plan. Okay, and you do some of the work before the end of the year. When you go to the client's premises before the end of the year, that's called an interim audit, okay, or a pre-year-end audit. You're doing some of the work before the end of the year. Now, how much of the work can you do before the end of the year? Normally, something in the range of 30 to 40%. Okay, so a very large portion of the audit work can actually be done before the end of the year. So normally that's what auditors try and do because they want to satisfy their client need, right, to get their audit report by end of January, mid-February. End of February latest. Okay, so audit firms have to do some of the work before the end of the year in order to meet those deadlines. So again, that visit before the end of the year is called an interim visit, sometimes called a pre-year-end visit, where the auditors will do some of the audit work before the end of the year. Now, an important part of the examination standards is the requirement to study the client system of internal control. We've already mentioned that auditors give a report on the financial statements, but we also said that the client has to provide a system of internal control over financial reporting, and that the auditors have to sign a second report, right, saying that the client system of internal control works, that it will prevent and detect material errors from arising in the financial statements. Okay, so the internal control system, the second last bullet point in this PowerPoint, number 32, it says internal control is a system's capability to prevent or detect material data processing errors or fraud and provide for correction in a timely basis. So that's what a good internal control system does. So as members of management, what you always want to do is yourself in the firm where you're working or interacting with the external auditors is our system of internal control. That's the detailed procedures in terms of how we run our business. Is that system adequate to prevent, or if errors occurred, detect material, okay, significant data processing errors, including fraud? And will our system of internal control then provide for those errors or fraud to be corrected in a timely basis? Okay, you want to devise your internal control system so the answer to this question is yes, that our internal control system will, number one, prevent, or if not prevent, number two, detect material data processing errors or fraud, and once detected, provide for correction in a timely basis. Auditors rely on their client system of internal control in order to reduce audit risk. So in a public company environment, this is another way that auditors can meet that tight reporting deadline of January or February. They put substantial reliance on the client system of internal control. Okay? And we'll talk a lot about internal control as we go forward. Excuse me. We've already mentioned the auditors have to obtain sufficient or enough evidence, right, to justify their audit opinion. Audit evidence has to be reliable, has to be relevant, has to be sufficient, as we already said. It's not absolute, right? It doesn't be 100% of the audit evidence, but it has to be enough. How much is enough? Well, we determine that based on our judgment. In some cases, we use statistics to determine how much evidence we obtain. Okay, so I mentioned earlier today, we have 3 standards under generally accepted auditing standards. The first one was the general standard. The second one was the examination standard. This is the third one, the reporting standards. Okay, the audit report, it says, should identify the financial statements. So it should identify the balance sheet, the income statement, etc., and distinguish between the responsibilities of management and the responsibilities of the auditor. Right? Who's responsible for what? In the old days, and I'll say the old days are not that long ago, but let's say prior to year 2000, the audit report was not very good in terms of its design. It didn't say who was responsible for what. It didn't say management's responsible for some things and the auditor's responsible for other things. Now it does. Okay, the audit report has been vastly expanded from what it used to be. Next day, I'll bring in an audit report. Okay, the one that was in existence when I first started auditing, and you'll see it was only a 2-paragraph report, and it didn't really say a whole lot. And because it didn't say a whole lot, that's the result of that was auditors got sued quite often. Okay. The auditor, the next bullet point, the auditor should determine whether the financial reporting framework adopted by management in preparing the financial statements is acceptable. So all that means is when you're doing the audit of a public company, IFRS has to be followed, right? In most countries around the world, other than the United States, they haven't adopted IFRS yet. But in most other countries, you have to conduct your audit of the public company based on the IFRS accounting standards. And if the client is not following those standards, you can't do the audit, right? Because they'd be following the inappropriate financial reporting framework. Okay. This particular PowerPoint 35 is talking about some of the Canadian audit standards. So we've already talked about the objective of an audit standard, and it talks specifically about the audit report, which we're going to see in a minute. Okay, so we don't have to talk about those specific standards. Now, when auditors give an audit report, most of the time you want what's called an unmodified opinion. Unmodified, it's sometimes called a clean opinion. Okay, a clean opinion means that it has not been modified. An unmodified report is one where the auditors say that the financial statements present fairly, right? It's a good report. The auditor is not calling attention to anything that might be wrong in the statements, and there are no what we call reservations. We'll talk about that in a minute, okay? And the auditing standards, international and Canadian, of course, set out the format for unqualified or unmodified audit opinion. We'll see that in a few minutes. However, there could also be a modified opinion report. So when the auditors have to modify their audit opinion, that's an indication there's something wrong. Auditors might have to modify their audit report because the client has not followed generally accepted accounting principles, which in our context is IFRS, right? So if a client, for example, under IFRS, they have to report inventory at the lower of cost and net realizable value. But let's say the audit client doesn't do that. They want to report at cost and not write down the inventory. So they have departed from IFRS. Well, the auditor has to draw that to the attention of the user of the financial statement. Okay, so that could be one problem, departure from IFRS. Another type of problem might be where management has limited the scope of the audit. We already said the auditors must get sufficient audit evidence and the right type. Well, maybe management says we're not going to give you certain audit evidence. So where management says we're not going to give you certain audit evidence, that's a limitation in the scope. Right? We already said a minute ago, auditors plan the scope. Well, if auditors plan the scope, management has to supply the information. But if management refuses, this causes a problem in what we call a scope limitation, which means the auditors cannot give an unmodified or clean audit report. They have to change their audit report. Okay? And now we're going to see in a few minutes the standard report. We'll just walk through it, okay, to see the various pieces. So the standard audit report, of course, is going to contain a title. So it usually, in most cases, just says independent auditor's report. If you looked at an audit report, in this example, in the text in the PowerPoint, they're just expanding it a little bit. It says the independent auditor's report on a complete set of general purpose financial statements. Well, of course, the the independent auditor's report is on the set of financial statements. So normally you just have these 4 words, or sometimes even 3 words, independent auditor's report. You don't have all these extra words here, okay? It's just for way of explanation that the authors have put this in. So normally it will just say independent auditor's report. You have to address the report to the shareholders, right? You're reporting to the shareholders of the company. Then in the next paragraph, you're going to state your opinion. So we have audited the company financial statements of ABC company. And then what do those financial statements comprise? They comprise a statement of financial position at December 31, 2000, whatever, and the statement of comprehensive income, statement of changes in equity, and statement of cash flow for the year then ended, and notes to the financial statements, including a summary of significant accounting policies. So in the old days, we just stopped here. We mentioned this financial statements, but we didn't add this part. Notes to the financial statements. So this is the auditor telling the reader, oh, in addition to all these numbers that appear in these statements, we've also audited the notes. And those notes include a summary of the significant accounting policies, right? So the fact that the auditor is saying this, the auditor is telling the reader of the financial statements, you better have a look at the significant accounting policies in these notes, right? Because we have audited them, and that's important information. Okay? But we identify the financial statements which have been audited, including the notes and the accounting policies. Then we're going to state our opinion. In our opinion, the accompanying financial statements present fairly. Okay, so when the auditor says the financial statements present fairly, that's an unmodified or clean audit opinion. That's what everybody's looking for, okay, the users. And this is what's given probably 99.9% of the time. Financial statements present fairly in all material respects. Okay, now the part in parentheses here, you can forget about, that's just, it says, or give a true and fair view of. Sometimes some countries in the audit of financial institutions, they say that you use this wording instead of saying the financial statements present fairly. You say they give a true and fair view of. Okay, so it's for a specific set of circumstances. So again, 99% of the time, you're going to have the wording financial statements present fairly in all material respects the financial position of the company at December 31, so at the year end, and its financial performance and its cash flows for the year then ended in accordance with IFRS. Okay, so this is the type of audit opinion users expect. It's the one that management knows has to be delivered if they don't want to have a problem with their users, their lenders, etc. So that's why 99.9% of the time, this is the audit opinion that's rendered by the auditors. Now, the auditors today want to tell the readers what is an audit, right? We already said the financial statements present fairly, but now we said the auditors want to tell the users a little bit about what an audit consists of. So now in our audit report, we say we've conducted our audit in accordance with international standards on auditing. Our responsibilities under these standards are further described in the auditor's responsibilities for the audit of the financial statement section of our report, where we are independent of the company, right? So here's the auditor saying we are independent. In the old days, we never said that. We are independent of the company in accordance with the Provincial Ethics Board. So in an international scene, that's the International Federation of Accountants. The ethics requirements are the same, okay? So in our case in Canada, it's a Provincial Ethics Standard Board for Accountants, Code of Ethics for Professional Accountants, together with the ethical requirements that are relevant to our audit of the financial statements for example, in Windsor, Ontario, this would say in accordance, the financial statements in Ontario. And we have fulfilled our other ethical responsibilities in accordance with these requirements of the code. So we're saying to the reader, we have fulfilled all of our ethical requirements and confirming we are independent. Right? That's how important that independence function is. We believe that the audit evidence we have obtained is sufficient and appropriate. There's the words we were talking about. Sufficient, we have enough, and it's appropriate. We have the right type to support the opinion that we've given in the financial statements. Something that's fairly new is auditors may, upon time, want to draw attention of the reader to what's called key audit matters, right? There are some items which are very important, and we want to draw the attention of the reader to those items. Now, most audit reports, there are no key audit matters, but sometimes there may be one item that the auditors want to draw to the attention of the user. So this is where they do it. In the old days, we had no key audit matter paragraph. Now we do. So key audit matters are those matters that, in our professional judgment, were of most significance in our audit of the financial statements of the current period. These matters were addressed in the context of our audit of our financial statements as a whole and informing our opinion thereon, and we do not provide a separate opinion on these matters. Okay, so we're not giving an opinion on these matters. We're just drawing the attention of the reader that we did consider these matters in the context of our audit. But because of their importance, we want the reader to be aware of them. Again, normally auditors don't even have anything to put into the key audit matters, but the provision is there now that if you want to draw something to the attention of the users, this is the way that you do it. Now, we said a minute ago, we should be talking about the responsibilities of management, right? In the old audit report, we never talked about this. So now we have a section, responsibilities of management, and those charged with governance, which is the board of directors for the financial statements. Management is responsible for the preparation and fair presentation of the financial statements in accordance with IFRS, and for such internal control as management determines is necessary to enable the preparation of financial statements that are free from material misstatement, whether due to fraud or error. So we're saying who is responsible for the financial statements? Management and the board, not the auditor, right? In the old days, we never told the user, oh, by the way, these are management's financial statements. The user always assumed they were the financial statements of the auditor because the auditor audited them. The auditor was supplying the financial statements to the user. They never said, right? The auditors never said that they're management's financial statements. Now we do, like, to clear the air so that the users recognize it's management put these things together. What's the auditor's responsibility? Just to express an opinion, right? To express an opinion on management's financial statements. In preparing the financial statements, management is responsible for assessing the company's ability to continue as a going concern, disclosing as applicable matters related to going concern, and using the going concern basis of accounting, unless management either intends to liquidate the company or to cease operations or has no realistic alternative but to do so. Those charged with governance are responsible for overseeing the company's financial reporting process, right? The internal controls over financial reporting. So management has a responsibility, the board of directors has responsibilities. What are the auditor's responsibilities? Our objectives are to obtain reasonable assurance, right? Not a guarantee, reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is what? It's a high level of assurance, but not a guarantee that an audit was done in accordance with international audit standards will always detect a material misstatement when it exists. Misstatements can arise from fraud or error and are considered material if, individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users on the basis of the financial statements. Okay, so here we're trying to give the reader some idea about what the objectives of an audit is and what the responsibilities of the auditors are. Again, in the old days, we didn't even have this paragraph. So the users were sort of left to guess, right, what the auditor's work actually consisted of. And then the audit report will simply be signed and dated, and the auditor's address, right, which office is responsible for the audit. So, of course, in today's world, we have global companies. So the reader wants to know, if I have a question about these financial statements, which office do I contact, right? So the auditor's address is given. And in today's requirements, in addition, the name of the audit partner, okay? The engagement partner who's responsible for the audit, that auditor's name also has to be given, okay? So that people know precisely, you don't only call up Deloitte, you call up a specific partner at Deloitte, right? If you want to know more about the financial statements, okay? So you can see the auditor's report today is very extensive, okay? Next class, I'll bring in 2 examples of audit reports for real life companies so we can have a look at those, okay, before we start our material in chapter 3, okay, just to give you an overview of what an audit report looks like in the old days, okay, when it was only 2 paragraphs, and what it looks like today, okay? Okay, so I'm just going to go forward here now. It just talks about disclosure in financial statements and report comment, assurance standards. This part on insurance, assurance standards you're not responsible for, okay? So from PowerPoint 51, goes on for a few, I know, 51 to 53, you're not responsible for. But let me just talk to this for a minute, because we're going to talk about it later in the course. PowerPoint 53, audits, right? Most of our course is about auditing. I mentioned reviews are done by many accounting firms. And then we also have something called non-assurance engagements, which are what we call compilations. So those are the 3 types of engagements normally done by audit firms. So those are the ones we're going to concentrate on, okay, in our course. Again, this PowerPoint 53, you're not responsible for. Here's the 3-party accountability. Okay, this is the PowerPoint I thought was at the beginning of the material. So it's at the end of the chapter, unfortunately. But here's the 3 parties I mentioned, right, that are responsible in the audit context. The users of the financial statement, the accountable party, which is management, they prepare the financial statement. And then we have the audit firm, right? So here's the subject matter. That's the financial statements prepared by management. management sends that information to the user. The practitioner, the audit firm, attaches their audit opinion to the financial statement, and that goes to the user. Right? So the user is going to rely on this financial statement from management because it's been audited by the practitioner, by the public accounting firm. Quality control standards, we've already talked about the fact that audit firms have to maintain sufficient quality control. Those quality control standards, here's the International Federation of Accountants I mentioned a few minutes ago. So those quality control standards are the same basically around the world, okay, in terms of the quality control that has to be met internally by professional firms. And then here are the elements of the quality control system that those firms have to meet. And I'll talk to these for a few minutes. So leadership responsibilities for quality, what we're seeing there is that if a firm wants to have a high level of quality control, the people at the top of the organization, right, should be saying that quality control is important, right? If the people at the top of an organization do not say that quality control is important, what's everybody going to think at the bottom of the organization? If my boss doesn't see it as important, why should I? Right? But if my boss sees it as important, I should probably see it as important as well. That's what leadership is about, right? The leaders have to say quality control is important if they want everybody else to think and act in a way that quality control is important. Relevant ethical requirements, you need to have controls in your audit firm to ensure that everybody is following the professional standards, ethical standards, objectivity, integrity, right? Independence. How does a firm determine that all those criteria are being met? One of the ways they do it is that they have everybody in the firm sign each year a document saying that they are independent of all their clients. Okay, that's one way to ensure that people are following the ethical rules. Of course, another way is, as engagements are performed, is to observe the behavior, right, and conduct of the people on the assignment and to evaluate them, right, at the end of each assignment in terms of how they did. So an internal reporting program. Thirdly, firms should have procedures in place to ensure that they only accept clients which are of high quality and that they only continue doing client work where the client management is reliable, right? Usually audit firms only let clients go and not service them anymore where they lose confidence in client management, right? They suspect client management maybe is becoming fraudulent, right, in their activities, misleading the users. And so they decline to be involved any further with that client. So we need quality control procedures in the firms to ensure that we do not accept clients that we shouldn't be accepting, and that we don't continue with clients where we should be terminating our arrangement. The next control, we need good human resource controls. That means we should only hire competent people, right? We should hire people that have had courses in auditing. We should hire people that are working on their professional designation or perhaps have it, depending on what level we're hiring for. We have to ensure that we have controls in place that our staff receive ongoing training, right? The professional development on an ongoing basis that we talked about. The next point, we want to ensure we have a high level of engagement performance in our firm. How do we determine that? I mentioned a minute ago, we should have evaluations done of our staff, right, after every engagement, so our staff knows how well they did or how well they didn't do. So that if they need to improve, here are some areas for improvement, right? So all firms have an evaluation process based on the engagements. All firms have usually a semi-annual and an annual performance review for everybody in the firm, including partners, right? So partners, very often partners with firms for their whole careers. Sometimes partners choose to leave because they want to go do other things. Right? Sometimes partners are asked to leave, right, where they're not maintaining professional standards or the firm wants to make other changes. Okay, So engagement performance, right, is very important to give feedback to everybody involved in the audit firm on their own level of performance. And then, of course, you need monitoring controls. We need controls in place to ensure all these activities we've talked about, right? The leadership, the ethical requirements, accepting and continuing clients, human resource controls, engagement performance controls. Are those controls all working or not? We have to have a review process, right, in place. We have to monitor those controls, make sure they're working, and make changes to them as needed on an ongoing basis. If they're working, can they work better? If they're not working, why are they not working? And we need to make some changes. Okay? All right, so this finishes off chapter 2 for today. Again, if you have questions at all after you listen to today's lecture, feel free to send me an email with your questions. And again, we can arrange a Teams meeting if you want to have a little discussion through Teams about any of the content that you're not quite sure of. My door is open. Okay, thanks everybody. Have a good day. And we'll see you next day. As I said, I'll bring in a couple audit reports for us to look at to start off with, and then we'll move into chapter 3's material. Okay? Have a good week and a good weekend. Take care. Bye-bye.